September 15, 2008, the world held its breath. That date wasn't just another Monday. It was the day a colossal 158-year-old institution, Lehman Brothers, collapsed. It wasn't merely a bankruptcy. It was a detonation that sent shockwaves across the global economy, revealing the precarious foundations upon which modern finance had been built. For decades, Lehman Brothers had been a Wall Street titan, a symbol of American ambition and financial prowess. From its humble beginnings in the cotton trade, it had weathered wars, depressions, and market upheavals, always emerging stronger. But beneath the gleaming towers and the confident smiles of its executives, a dangerous game was being played. A game of leverage, of complex derivatives, and of a housing market that everyone believed could only ever go up. The seeds of its demise were sown years earlier, in the fertile but increasingly toxic soil of subprime mortgages. These were loans made to borrowers with poor credit histories, packaged and resold as seemingly safe investments. Lehman, like many other firms, became deeply entrenched in this market. They weren't just facilitating these loans, they were creating elaborate financial instruments known as collateralized debt obligations, or CDO, bundling these risky mortgages together. By 2007, the housing market started to falter. Foreclosures began to rise, and the value of those subprime mortgages plummeted. The seemingly invincible CDOs, once rated AAA, were suddenly revealed as toxic assets. Lehman, with its immense exposure to these assets, found itself in an increasingly desperate situation. Their balance sheet was burdened with billions in illiquid, devaluing investments. The market was losing faith. Richard Fuld, Lehman's CEO, a figure often described as the gorilla for his aggressive trading style, was fighting for survival. He sought buyers, partners, any lifeline that would keep his firm afloat. Over the critical weekend of September 12 to 14, 2008, frantic negotiations took place. The Federal Reserve, the Treasury, and other major banks converged in a desperate attempt to orchestrate a rescue. The memory of Bear Stearns' collapse just months earlier and its subsequent government-backed bailout loomed large. Many expected a similar intervention for Lehman, but this time, the political will had shifted. Treasury Secretary Henry Paulson, a former CEO of Goldman Sachs, found himself in an impossible position. He just used taxpayer money to save Bear Stearns. Doing it again for Lehman was politically untenable. The message from Washington was clear: no public money for Lehman. The expectation was that private banks, perhaps Bank of America or Barclays, would step in, but neither firm could stomach the risk without government guarantees. Imagine a room filled with the most powerful figures in finance watching the clock tick down, the air thick with tension, the stakes unimaginably high. This wasn't just about one bank, it was about the entire system. The talks failed. As the sun rose on Monday, September 15, 2008, the news broke: Lehman Brothers would file for Chapter 11 bankruptcy. It was, at the time, the largest bankruptcy in U.S. history. The images are iconic. Employees carrying boxes of personal belongings, their faces a mixture of shock and despair. A 158-year legacy evaporated overnight, but the real panic was only just beginning. Lehman's collapse triggered a domino effect. Its creditors, counterparties, and derivatives partners suddenly faced billions in losses. Trust, the lifeblood of finance, vanished instantly. The interbank lending market, where banks borrow from each other, froze. No one knew who was solvent, who was exposed. The global credit system, the very engine of modern commerce, seized up. The ripple effect spread beyond finance. Businesses couldn't get loans, consumers couldn't get credit, and the global economy plunged into the worst recession since the Great Depression. The government was forced to act, eventually initiating the Troubled Asset Relief Program, or TARP, a massive bailout package for the financial sector, a move that remains controversial to this day. The fall of Lehman wasn't just a corporate failure. It was a systemic shock that exposed the profound interconnectedness of the global financial system and the dangers of unchecked risk-taking. It led to an era of increased regulation, like the Dodd-Frank Act, aimed at preventing a similar crisis. Yet, the memory of that Monday morning serves as a stark reminder of how quickly the seemingly invincible can crumble. The systemic collapse of Lehman Brothers forever altered the landscape of finance, a cautionary tale etched into the annals of economic history, a monument to the dark side of ambition and the devastating cost of unchecked speculation. Next, we unravel the true cost of unchecked innovation in the dot-com bubble.